Congratulations, you've built a successful business. But now what? Hi, my name is Jackie Ip, Certified Financial Planner at Ocean 6 Wealth Advisory. In today's video, we're going to go over some of the common strategies we use with our clients to build up their investment portfolio inside their corporation and find out what successful people are doing with them. So generally speaking, we encourage our clients to start thinking about investing inside the corporation with their holding company. If you can, move the money inside your holding corporation before you start the investment. And one of the reasons why you want to do that is because you're going to be mingling some of your assets from your operating company for your personal retirement needs. And that could cause a problem down the road when you start to liquidate or think about taking the money out. But we won't get into that in details in this video. But if you have a holding company, we encourage you to use your holding company for the investments, not your operating company. Let's take a look at the retained earnings. It is the after-tax money that you have inside your corporation. And if you took that money out of your retained earnings, you're going to be taxed personally. Whereas if you left it inside your corporation to do some investments, you can start to really build up your portfolio and have a tax-winning strategy. By now, you might be asking, what sort of vehicles can I be using to effectively build my investment portfolio inside my corporation? The most common tool that people talk about are corporate class investment funds. Make sure if you are going to be using investment funds, they are corporate classed. And the reason for that is because they have a much more tax efficient way of taking that money out rather than regular investments. So make sure you're speaking with a professional and that you are buying corporate class investments if you are making investment funds inside your corporation. Alternatively, you might want to buy some individual stocks. And because with all the different tools that are available with the low fee options world, it might be a very efficient way for you to start doing some investment as well. Maybe something you haven't thought about or remembered is that you can actually invest in other businesses and other ventures. It is a very common practice for you to reinvest some of your earnings into other businesses that you are interested in. That is always a good way to start building up your portfolio because you have more control than some of the investment options out there. And of course, who can forget about real estate? Real estate is a very common investment strategy for us to build long-term wealth and have passive income. Unconventionally, there are cash value insurance such as whole life and universal life, and critical illness insurance where you can utilize the return of premium features to pull out some cash out of your corporation. Before you make any investment decisions, you want to first check in with yourself and know the purpose of you building up these portfolios. Get to know why you want to do them and the goals that you want to achieve. And at Ocean 6, we use the blueprint process to help our clients get clarity and confidence with their financial plan and really set down long-term goals for them to build a financial future with. Before you make any of these investment decisions, you first want to check in with yourself. Understand why you are making those investment choices and if they align with your long-term future goals. At Ocean 6, through our blueprint process, the first thing we do is get clarity about the future you and set some real long-term goals for you to build your financial future on. Some of the other things that you might want to consider when you're making these investment decisions is when and for how long. When do you need this money and for how long you need this money for? Some of our clients make some rash decision about the investment because it's a good opportunity and forget that the risk associated with it is not appropriate for their time frame. So make sure you know and you're clear about when you need this money and if the risk of the investment matches that time horizon. In step 4 of the blueprint process, we do a deep dive on some of your current investment and make sure they are risk appropriate to you and your future needs. Lastly, you want to remember about the net rate of return. Don't forget there are fees and taxes with any investments. Make sure it is the net rate of return that you're looking at and not the gross. We might get excited about the rate of return on our investment, but forgotten some of the taxes associated to the different strategies that we decided on. So decide on what is the most tax-efficient tool that you can use to grow your investment portfolio. And finally, you want to think about the passive income rule. Back in 2018, Canada added a new passive income rule test. In Canada, if you have $500,000 or less in income, you qualify for the small business deduction, which means you pay less taxes on your active income. But if you have a $50,000 passive income or more, you now to start to claw back some of this limit. And it works on a 5-to-1 exchange ratio. For every dollar that you're over $50,000 in your passive income, you claw back $5 on your small business deduction. Let's use a quick example. If you earn $60,000 in your passive income, the first $50,000 you will not be penalized. But from $50,000 and $1 to $60,000, you will now draw back 5 times that amount in your small business deduction. So in this example, that would be $50,000 will be taken off your small business deduction, meaning the first $450,000 you pay at a lower tax rate, but from $450,000 and $1 and above, you now start to pay a higher tax rate. Ultimately, you end up paying higher tax rates on both your passive income and your active income. So be very cautious about your investment portfolio and see if they are earning more than $50,000 annually. If you are, you may be clawing back some of your small business deduction and paying a higher tax rate the following year. Now, it's not all bad news. If you make investment inside your corporation and they create capital gains for you, you will now start to be able to take out some of this money tax-free. Usually in a capital gain investment, half of it is taxable to your corporation, the other half is tax-free. Now, once you have those credits, they fall under something called a capital dividend account, CDA. It is a notional account where they start to accredit any tax-free dollars you can pull out for the corporation owners. So remember, if you are making investment options inside your corporation, make sure you are also checking for capital dividend account to see if you can pull out some tax-free dollars out of your corporation. At Ocean 6, we specialize in helping business owners and incorporated professionals to build an effective financial plan through maximizing their corporate benefits, like some of these investments that we talked about in this video. Remember, a successful investment portfolio is not just about rate of return. It's about having effective planning to create the financial future that you dream of. If you have any questions about the investment strategies that we talked about in this video, or have questions about the blueprint process, please click on the link down below and book a call with me. I look forward to speaking with you soon.